Crash or correction, the Fed's important interest rate decision tomorrow, and John McGrath's home price call. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. I'm really mad, Paul. Is this a crash or a correction with the stock market?
Getting harder to call that one, Peter. I mean, look, a lot of stocks in the US are now in bear market territory, as are some of the indices. And I guess we're sort of flowing on here. So I still put it in the correction phase, but it's going to be a long road back at the moment because there's not a lot of confidence. And the US certainly, there's, as I said, as you said repeatedly, the people have got very bearish about world growth all of a sudden, and that mindset takes a lot of
And the funny thing is, Paul, it's like the growth expectation was great, and it's really only been pulled back to good, but the market's selling up as though it's going to be like recession around the corner, and none of the real economic indicators are saying that. So I reckon it gets down to two men's decision. Jerome Powell, the Fed tomorrow on interest rates, and Donald on what he does with trade. Now, if those two guys come up with really good decisions, then I reckon we've proved this is only a correction and there will be a stock market rebound. But not a big rebound. I think it'll probably first up, but then it'll be slower rise because the US is going to grow slower. Yeah, but it'll still grow.
I mean, unquestionably, those two men hold the key. Or I guess with Jerome, it's a little bit more than him, but there's a team. But the
two men and a baby. The stock market is our baby.
Donald, we can talk about, is just an individual, and he holds the bigger key. So look, the Fed decision tomorrow is important. The market still expects the December rate an increase tomorrow, but I think no increase in March. No, we'll get the dot plot. And we'll just see what their projections are.
So tell people what dot plot is.
So the Fed governors actually at each of these meetings are asked to sort of make a projection as to where they think interest rates will be in the end of at the end of the next 1 year, 2 year,
it's
and
like
3
an official
years
guess, isn't it?
It's like an official guess, and they don't name which the governors says has particular views, but they just aggregate it. We get a dot plot. So I think there's 16 on the Fed, and you end up with 16 dots showing the range of forecasts for interest rates from 1, 3, and 5, and 1, 2, 3 years out, and that's the dot plot. So you can work out from that how many more increases they, on average, expect. Yeah. And I guess we're probably looking to that to be hosed down, certainly the rates next year expectations.
Okay, so let's just try. The US has a number of reasons to sell off. Overvaluation of the tech stocks, the trade war problem, would interest rates rise too quickly, and you can throw all the other things like Brexit and all those geopolitical issues that would spook the market at various times. But Australia is doing worse considering the fact that our economy is actually probably growing faster than the US now, and that is because the Royal Commission and APRA have had a big impact on the lending to home buyers, and that's probably increased the fall in house prices, which in Sydney now is minus 9.7%. Melbourne's about 7%. Now, and John McGrath, he's come up and said, well, I think we're getting close to the bottom. He thinks CoreLogic's a little bit behind. He thinks Sydney will end up dropping about 15% in the end. Melbourne around 10 or 12. So, but you throw all these negatives in, you understand why our market's down.
Look, I think our market is down because of the absence of things to sell, so that's why the banks are copying the pressure. Resource stocks are holding up in the large because I think of the big buybacks. Has taken a lot of stock out of the market. And the iron ore price, despite, if you're already worried about China, it actually has held up pretty well. So there's a suggestion maybe that China's stimulating will go back to its normal stimulatory approach and more construction spending that, at least in the short term, will create demand for iron ore. They're holding up. I think it's the market saying, what else do we sell, right? And that's the challenge. But look, so our market's done probably worse, at least than other markets globally. And we're in that sort of phase. Let's come on to the property question. Really interesting what John McGrath's got to say in today's Switzer Daily about almost calling a bottom in housing prices. Is that something you see, or Peter, or what?
Well, it's hard. He's at the coalface. He's seeing auctions all the time. He knows that people are showing up to say, oh, I know house prices are down. I'm interested to buy properties. And so I wouldn't ignore him. Even though John has had some stock market problems with his company, he still is one of the smartest real estate guys in the country. And Charles Tarby from Century 21, which we interviewed on our radio podcast earlier in the week, he had the same kind of feeling about that as well. And he just said that the election is going to be a problem for housing comebacks. He thought spring of next year would probably be the time when everyone realises this is enough, the falls.
Yep.
But if there's a recession around the corner in the US or something like that, house prices will go down even further. And so watching this international setting and its implications on the Australian economy is going to be really important.
Yeah, look, I know a lot of people that I talk to and what I would describe as canny investors are starting to think about the housing market as a place to look at again, which does give a bit more credence to sort of people like John McGrath saying, well, we've had this fall. Yeah. Look, the fall hasn't been caused by unemployment or interest rates.
No.
It's just a market that went up too quickly.
Yeah, and the APRA said, investors no more, Chinese no more.
Yeah, so a few buyers pulled out of the market, investors pulled out of the market, prices slipped, which is what you'd expect. That's how markets
and the banks
react.
are being tougher if you want money.
The banks, and they won't lend as much. Yeah. So that's one of the reasons why prices had to come down.
It's probably why bank share prices are going down too.
The underlying demand factors from population growth, immigration growth, hasn't changed, right? And so you've got to put that in context and infrastructure. So I think that the market housing is going to be a place that I'm going to be looking at investing next year because I think that's starting to look more interesting.
So are you going to show up to auctions on Saturday?
I'm not sure
lean on the fence, hoping that, buy that.
I think I'm going to be a bit more candid. I don't know. I hate to. You never know, Peter. I might not have anything better to do.
I do know a lawyer, a Macquarie Street lawyer, who did exactly that. Every Saturday afternoon, he would just turn up to auctions. Not sure whether he was going to buy, but he had cash available to put the deposit down if he had to, and he bought some fantastic property when people were scared.
Yeah,
when people are scared, you buy.
Yeah, I think you got to look at that. Look, and maybe let's come back to the share market. Well, let's see how it plays out. Those two, Jerome Powell and President Trump hold the key in the short term.
Okay, well, I'm Peter Switzer.
Well, we were going to talk briefly
about DRP. Andre sends a question, a viewer.
Well, you asked a question about dividend reinvestment plans or distribution reinvestment plans. Are they like any other form of dividend? The answer is yes, because the taxation issues are exactly the same. So if you just, rather than taking the cash, if you decide to take the units or the shares in a company that offers one of these plans, you have exactly the same taxation to pay, but rather than get cash, you get units.
Yeah. And we should explain that when you get your dividend, you can accept it as cash and pay tax on it, or you can say roll that money into to buy some more stocks, and so you're reinvesting your dividend, and so you can build up your stock holdings. That way. There's your way.
And look, there's great things about the strategy, but they're not totally set and forget. So I think you've got to pick the company and pick the type of investment. And really each time you should think about, is that the type of thing you want to do? But for small investors trying to build a portfolio, they're generally good things over the long term in the right quality companies. Yeah. And you mentioned about, we were going to talk about Switch, just very briefly. Does it have a distribution reinvestment plan? It does. It's due to pay a dividend on the 17th of January. It goes ex on the 2nd of January. I think you've got to get your instructions in by the 4th of January. So just a couple of days before Christmas, they'll be able to announce an expected dividend or expected distribution. And you can actually nominate, like you can in lots of companies, to rather than have the distribution in cash, take it instead in more units.
It's like putting your money on and letting it roll.
It's a bit like that, Peter, letting it roll. And that's, I guess... brings us to the end, doesn't it?
That's right. I'm Peter Switzer.
I'm Paul Rickard.
And I'm mad about money.
Content has been prepared without taking account of an individual's financial objectives, needs, or financial situation. It does not constitute formal advice. Before acting, any individual should consider the appropriateness of the information, having regard to the individual's financial situation, needs, and financial objectives. Past performance is not a guide for future performance. AFSL 286531.